Thank you so much, and good morning, everyone. Uh, Today, we all know that we are amidst very favorable macro trends today, and how these trends are shaping up in terms of where are we heading into from an economic perspective, and therefore what influence it will have on your asset investments, be it fixed income, be it equities, or be it any other asset class. So, just to the macro trends really impact companies. When you look at companies don't operate in a vacuum. There is a lot of many things that influence how companies operate, be it which sectors they are in, which kind of policy making is conducive for them or not, whether there is politics in terms of the government policy making or any other aspect, how that will drive that company's businesses. And at the end of the day, the larger thing, the society, how it impacts society, and therefore what kind of products will succeed or not succeed. So if you see, India at one point in time was a sone ki chidiya, right? We were very large portion of the global world. If you see something like United States, didn't appear at that point in time on the map anywhere because it was non-existent. But if you see over a period of time, we have lost share along with our peer group countries like China, we have lost share. But now again, both these nations are emerging in terms of taking its own share of the pie of global GDP. So India is today close to about 3.5% of the global world. India will become 14% by 2050. So India is going to become a dominant player in the global world when it comes to GDP growth. So we are all headed towards a very high growth regime, and we will command a dominant position in the world going forward. How is this going to happen? Do we need stratospheric growth from here to reach that 14%? No. We just need a growth rate of about 6.5% real GDP to reach that 14% of the pie. Remember that the global world is slowing. The growth in the global world is going to be around 2, 3, 4% at max. We will be at 6.5% real GDP growth rate, and that's enough for us to reach that 14% of global world. And this is something that we have seen over the last 40 years. India's growth rate since 1980, and we have seen it everything. Single-party government, coalition government, flood, famines, assassinations, wars, etc. Still we have grown at about 6.2% real GDP growth rate for these 40 years. And we don't see that changing, right? Someone will come and tell you that India will grow at 8, 9, 10%. Don't buy that story. We are not there yet. We need a lot of things to come in place to grow at that pace. But until then, 6.5%, 7% is a very respectable growth rate in today's world. Also, why growth matters? Because growth reflects in stock market returns. We are not like China, where growth is at some level and stock markets have not kept pace with growth. India, growth really reflects in terms of what returns you end up making in the stock markets. Also, one thing, macro trend that really helps India is the inflection point that we are at. You would have heard many people talk about that we are at about $2,200 per GDP, per capita GDP, and from here the growth accelerates. And there is a blueprint in terms of other economies who have surpassed this level and had that growth had accelerated. Look at various economies. The green arrows that you see on the chart are those points for other economies when they were at similar growth per capita GDP, that is 2,000 and above. We are standing at the cusp, and from here on, that should lead to a higher growth rate, because at this level of per capita GDP, you move beyond the roti, kapda, and makan and into various things that we want to consume, aspirational consumption as we call it, and therefore there is a lot of discretionary spend that leads to that acceleration of growth. Also, we have a demographic dividend. The global world, it's aging faster, and we are still very, very young. And we have seen that, before the time when population peaks, the 10 years before that is a very superior growth. We have seen that in case of China. We have seen in case of India. So we will peak closer to 2030. So from here on till 2030 will be an accelerated growth that we will see. Also, one of the important drivers of today is real estate. If you see, real estate sales have been rising, if you see the chart there, and that has only been driven by affordability. What had happened was home prices had remained stagnant and incomes were rising, and that has led to the growth in terms of real estate affordability and therefore real estate sales. So if you see, affordability is at its peak today, despite home loan rates at 8.5%, 9%, still there is a very high affordability because incomes have gone up over the last 10, 12 years. Also, one more important factor that's helping India is people are looking to diversify from their production bases in China and elsewhere because of the disruptions that we are seeing. And that is helping, and we can see it in the numbers. The exports of goods, exports of services have been going high, and we think this trend can continue if there is right policy making that can help shape up this aspect further. Also, if you see, infrastructure is expanding fast. If you see roads, railways, ports, etc., we have seen a good growth when it comes to infrastructure. Are we in a good shape? Yes, we are doing what we can. But is there room to do more? Yes, there is room to do more. For example, if you see ports, for example, port handling capacity, turnaround times have gone down or gone up. But if you look at the cost of logistics in the country, still is very, very high. And that is because the warehousing is not yet formalized, and therefore the warehousing cost eats up into your increase your cost, and therefore logistics cost is still very, very high in India. It is one of the highest in the world today, still at around 13, 14%, which should come down to less than 8% for it to really make a difference. So if you see, this is the comparison of where we stand and where other economies, large economies like China, US stand. If you see many things like, for example, electricity production, because electricity is required for growth, right? Cheaper sources of energy leads to higher growth. So if you see, our electricity production is much lesser than what we see in United States and China. Also, if you see, in terms of, we talk about we have a very good road and rail network, still we are very, very small as compared to other larger economies. So we have a long runway to grow, right? Until unless we have all this in place, that aspirational growth of 8, 9, 10% is unlikely to be achieved. Also, if you see, I mean, in terms of even like something like hotel rooms, right? The branded hotel rooms in India, the number is very, very small when you compare to the likes of China and US. For example, the number of branded hotel rooms in India is 144 million in India versus 3.7 billion in US. So we have a long runway when it comes to the infrastructure that we need to develop for us to gain that advantage. Also, if you see, we are hungry consumers. We all have aspirations, and there is a bigger market. For example, the cell phone, if you've seen, they've grown really in a big way because there was affordability. Once we have affordability in other segments, like two-wheelers, four-wheelers, or any other white goods, probably you will see similar kind of growth taking place in other places as well. So there is a big runway for growth as incomes increase. As people get better jobs, their income increases, and they will be big consumers going forward, as we have seen in the case of cell phones. Also, if you see, as I said, there is bigger headroom to grow. Look at mortgages as a percentage of nominal GDP. We are just at 11%, and if you see, the developed markets are anywhere about 50%. So there is a big runway in terms of home ownership yet to take place. As people come into formalized working environment more, and as they are able to take more loans, you will see that housing has a very big runway, and it will continue to grow. So what does this macro translate to your asset classes, equities and fixed income? Let's look at that. So overall, we have seen a good trajectory in terms of revenues increasing of companies and profitability going along with hand. So we think that this trend, given the favorable dynamics of growth, it will keep continuing. Inflation is going to remain very, very controlled. Government has a very high focus on controlling inflation, and I think we are on a good shape when it comes to inflation not impacting profitability to a large extent. So if you had met us in the period of 2015 to 2017, we were very, very bearish on markets, right? There was a lot of hope during that period, but was that hope translating to numbers? It was not the case. So if you look at the period from 2014 till 2017-18, these are the earnings estimates of brokers in the country, right? If you see every year, what people said that, there is a single party government, there's going to be a lot of reforms, economy is just going to zoom, right? And look at earnings in that period. Earnings were very, very flattish. Everyone said that, earnings will start at a very high level, but it never translated into earnings at the end for the companies. There was no revenue growth. Things were not moving on the ground. There was no earnings growth. So it was like a ski slope, right? Every year you start with a high expectation and end with a lower number. But this time around, there is earnings growth, and earnings growth is zooming fast. So every year, we are starting at a lower number, ending higher. So what was happening in the period 2015 to 2017, the reverse is happening now. People are shy to say that there will be earnings growth, but there is actually higher earnings growth than people are anticipating. And we think this will continue, and which is a very, very bullish sign for equity markets. This is the earnings growth trajectory that we have seen. If you see, there is a flat lining happening between 2013-14 till 2018-19, and then it has zoomed up. And expectations of earnings growth going forward are even higher. And at the end of the day, come what may, market reflects earnings growth. Look at this, a rebase chart of earnings growth and market movements. They both move in tandem. And foreigners have not been able to benefit much from this India shining or India growth that we have seen in stock markets. Look at the stock market in comparison to other markets. We have done really, really well. And foreign investors have not been able to participate in this. So will they come to India? Look at the difference between the flows in China has received and what India has received. So Chinese flows, be it FDI or FII, have been much, much larger than what we have seen for Indian markets. Also, if you see, we are in a very good shape when it comes to the macro or the micro. The balance sheets are very, very healthy. Corporate debt to GDP is very low. Return on assets have been improving. Banking sector, NPAs have been declining, and capital adequacy is high. So we are all set for a very high growth regime from here on. Also, if you see, there is a clear, you can connect the dots in terms of how it flows. So pension sovereign funds globally have about $100 trillion. Fixed income allocation from the RKT is nearly 30–40%. Their allocation to India is very low currently, but assume they allocate 1% to India, which is $300–400 billion, and current ownership is only $40 billion. So there is a big runway even for fixed income markets to attract a lot of flows from these foreign investors. And if they translate to $100 billion of flows, it could really add 1% to GDP if those investments translate to savings to, again, investments in a productive area. So overall, the flows from these foreign investors can really translate to higher growth, provided we channelize it well. People ask us, what are the risks? We think jobs are one of the biggest risks that India can have. We need to create close to 28,000 jobs per day for next 10 years for these people who are entering the workforce. Coming to fixed income, very favorable demographics. Inflation has been coming down. We are seeing fiscal deficit bond issuance being controlled. And at the same time, foreign inclusion will help drive bond buying in our markets. But all said and done, markets will remain volatile as we have seen cyclicality in asset markets across. And Therefore, asset allocation is what you could see that should drive your decision making, because there is not much that you lose up in terms of returns, but from a risk perspective, there is significant risk benefit that you get when you have an asset allocation. There is lesser volatility, lesser downside risk, and therefore a great way to take advantage of the macro trends that we are seeing unfolding in our market. So overall, I think focus on what you can control and ignore the noise. So what you can control is asset allocation. Macro trends are very favorable for all asset classes, be it equity, debt, and gold. So kind of asset allocate and take advantage and ensure that your returns are much higher commensurate to the risk that you are taking. So with that, I will stop here and happy to take any questions that you may have. Thank you.